After learning about popular customer-based value metrics in Chapter 5, we now come to strategic customer-based value metrics. This chapter proceeds to conceptualize strategic metrics of customer value and introduces popular customer selection strategies and techniques to evaluate these strategies. First, we will come to RFM value. RFM stands for recency, frequency, and monetary value. 1. Recency, a measure of how long it has been since a customer last placed an order with the company. 2. Frequency, a measure of how often a customer orders from the company in a certain defined period. 3. Monetary value, the amount that a customer spends on an average transaction. We will come to an example to explain RFM value. A company with a customer base of 400,000, we will take from these 400,000 customers a sample of 40,000 customers who are representative of the whole customer base. Also, assume this firm is planning to send a marketing mailer campaign of a $150 discount coupon to be mailed to its customers. After this campaign was performed, 808 results were obtained, equivalent to 2.02% in the sample surveyed. In recency coding, we'll code the customer's purchase from 1 to 5, with 1 being the most recent purchase date, and descending to 5 being the furthest purchase date. We can see that the mail ratios divided by these 5 sections are 4.5% for column 1, 2.8% for column 2, and 0.25% for column 5, respectively. And the average of these 5 columns is also equal to 2.02%. Similar to frequency coding, metrics are also coded from 1 to 5, with 1 being the most purchase frequency and 5 being the least purchase frequency. And with monetary value coding, with 1 being the most money customers spend and 5 being the least. After encoding these metrics, we sorted these customers into groups with units of R, F, and M respectively. For example, the most recent purchase, the average purchase, and the most purchase amount are coded as 131. Customers buy for a long time with a score of 4, the frequency of purchases is less with 4 points, and paying very little is a score of 5, we have 445 and so on. Next comes to the B index is break-even value, which is understood as net profit from a marketing promotion equals the cost associated with conducting the promotion. For example, with the cost to send 1 email is $2.50 and earn $85 in profit, how much is B? TAR will divide 2.5 by 85 and multiply by 100 to get a B index of 2.94. Next is the break-even index, BEI. The break-even response rate just computed could be used in computing a break-even index, BEI, for every RFM cell. Continuing with the last example, if we really only have 5.3% of customer responses, we get a BEI of 80.27. The following is a summary of the results of our company's last campaign. Includes RFM codes, B and BEI indicators. A positive BEI value indicates that some profit was made from the transaction. A BEI value of 0 indicates that the transaction just broke even, and a negative BEI value indicates that the transaction resulted in a loss. This is a table that demonstrates that when using RFM methodology, we can focus on customers that bring many benefits to the company such as 111, 121, 113 and ignore customers such as 455, 555, 454 to avoid wasting budget. Specifically, we can see in this table a profit of $217,932 instead of a loss of $363,200 when not applying RFM. The final of the RFM method is the relative importance of R, F and M. Here is one specific example. In the recency score table, we have 3 customers, John, Smith and Mary. Points for recency, 20 points if within past 2 months, 10 points if within past 4 months, 5 points if within past 6 months, 3 points if within past 9 months, 1 point if within past 12 months, relative weight equals 5. And in the frequency score table, with the same 3 customers as above, and points for frequency, 3 points for each purchase within 12 months, maximum equals 15 points, relative weight equals 2. And in the monetary value score table, points for monetary value, 10% of the dollar value of purchase within 12 months, maximum equals 25 points, relative weight equals 3. We have a summary table of information of 3 groups R, F and M above. Mary customer has the highest total score of 308. This is the target customer that the company needs to focus on to increase incentives and promotions to increase the loyalty of this customer. Besides, the potential of customer John is also very high with 249 points. This is also the customer that the company needs to pay attention to. And client Smith seems to be wasting the company's campaign costs, so there is no need to focus on this many clients.
PCV is some literature that assumes that the results of past transactions are just some statements of the customer's future contributions. Moreover, determined based on the total contribution, for profit, that the customer has provided in the past. In addition, business can compare PCVs of a customer group, can prioritize high-value customer groups in future marketing strategies. Because products or services are purchased at different points in the customer's life, all transactions must be adjusted for the time value of money. Next is the limited part. Specifically, PCV doesn't consider whether the customer will be active in the future and does not include customer retention costs. Here is the calculation formula. In this formula, I is customer, T is time index, delta is applicable discount rate, for example 1.25% per month, T0 is current time period, T is number of time periods prior to current period that should be considered, GC it is gross contribution of transactions of customer I period T. Look at the example above. In 2022, CGV in 2 Duke after 5 months observing one VIP customer, Nguyen Dang Tung, 25 years old. Assume the contribution is 0.1 and the monthly discount rate is 7%. Specifically, GC is contribution level X purchase amount. After relying on the formula can calculate PCV is 44.13. Conclusion, Tung contributed 44.13 thousand dong in May in 5 months of observation. It is important to assess the long-term economic value of a customer to a company. Moreover, lifetime value metrics to evaluate marketing resource allocation plans and put in place control measures in a timely manner to improve long-term customer value. In addition, LTV multi-stage assessment of customer value to the company. In particular, lifetime value, LTV, as the customer lifetime value, CLV. LTV of each individual customer I is the total discounted gross contribution of the customer during the observation period T. Moreover, LTV is a measure of a customer's value to the company. Basic LTV model is a simple formula to calculate LTV. Used for educational and conceptual purposes. Usually based on past customer behavior and may have limited diagnostic value for future decision-making. In addition, contribution margin and total observation time will be based on actual available information or internal customer data. Interest can be collected from finance. In this formula, I is customer, T is time period, delta is interest, or discount, rate. GC it is gross contribution of customer I at time T, T is observation time horizon, LTVI is lifetime value of an individual customer I in net present value at time T is 0. LTV with splitted revenues and costs. At the next level, we can break down the GC into its constituent elements, namely revenue and expenses. Depending on data availability, LTV may be supplemented by including service-related costs, delivery costs, or other associated cost factors. Here is the calculation formula. In this formula, DC it is direct costs of products purchased by customer I at time T, MCIT is marketing costs directed at customer I at time T, LTVI is lifetime value of an individual customer I in net present value at time T is 0. LTV including customer retention probabilities. At the next level based on the fact that more and more customers end their relationship with the company over time. Consider the probability of customer retention, RR, into LTV. In addition, there is also AC deducted from the value of the customer. Here is the calculation formula. In this formula, RRT is average retention rate at time T, GCIT is the gross contribution of customer I at time T. ACI is costs of acquiring customer I, acquisition costs. LTV with constant retention rate and gross contribution. Based on a hypothesis that assumes an infinite total observation time, the retention rate, RR, and GC don't change over time. From the above formula, LTV including customer retention probabilities, we have the formula. The margin multiplier when applying this formula, we can easily calculate faster and simpler than the above formula. How long is lifetime duration? Lifetime duration doesn't mean anything with one-time purchases. Moreover, long lifetime duration depends on your CRM strategies. For all practical purposes, if lifetime duration is managed, this period will be longer. In particular, it is important to make educated judgments about CRM and to make decisions on a case-by-case basis in a reasonable amount of time. Incorporating externalities in the LTV. In the era of technology development, the value that customers provide to businesses includes not only revenue streams but also activities such as plus the product evaluation on social networking sites such as Facebook, Instagram, website, plus communicating a personal opinion about a product or brand, is greater than these activities are grouped under word of mouth, WOM, terms. Measuring and incorporating WOM. WOM can directly affect new customer acquisition through reducing AC. Moreover, measure WOM impact on revenue and cost lead to impact on LTV. To incorporate the value of WOM in the LTV calculation, we need to determine the AC savings per customer due to referrals and the number of new customer acquisitions, NE, incurred due to customer referrals. Here is the calculation formula. In this formula, N it is number of new acquisitions at time T due to referrals of customer I, ACST is average acquisition cost savings per customer gained through referral of customer I at time T, ACI is costs of acquiring customer I, acquisition costs. Alternative ways to account for externalities. WOM not only reduces AC but also affects the frequency of purchases, the volume of purchases leading to an impact on the customer's LTV. Since to solve a key issue of who will calculate the added value of a customer J if his GC increases due to WOM, the customer referral value can be segregated from the LTV. Specifically by calculating separate customer referral value, CRV, for each customer. Moreover, the evaluation combines both metrics to help management select and determine how to grow the business's customers. Customer Value Matrix. This matrix will tell us who are potential customers through two indicators CRV and LTV. Where does the information come from? Information on revenue, direct costs, and marketing expenses comes from the company's internal records. In addition, many companies install activity-based costing, ABC, programs to achieve proper allocation of customer and process-specific costs. Evaluation. LTV, or CLV, is a suitable forward-looking metric for long-term decision-making. Moreover, it is a flexible measure that must be tailored to the specific business context of an industry. Customer Equity. Customer equity, CE, is the total LTV of all customers of a company. Evaluation of the company's value at a particular point in time due to customer management efforts. Moreover, CE represents the value of the customer base to a company. Therefore, this metric can be considered as a link to a company's shareholder value. To strengthen CE management efforts should focus on increasing the number of highly profitable customers while reducing the number of unprofitable customers. Here is the calculation formula. In this formula, I is customer, I is all customers of a firm, or a specified customer cohort or segment, LTVI is lifetime value of customer I. Customer Equity Share, SEI. SEI is an alternative metric for MS, market share, that takes into account customer LTV. In addition, SEI is a relative measure of the value of a brand identity in a company. Here is the calculation formula. In this formula, J is focal brand, K is all brands a firm offers, CEJ is customer equity of brand J. Comprehensive example. In the section, there will be exercises to review the above formulas, which you can refer to in the book.
So, I will talk about popular customer selection strategies. In this part, we will learn about some methods of choosing profitable and target customer for the company. From that, we can allocate resources of company effectively and reduce cost. Profiling. About these methods, it will help us choose future customer based on common characteristics of the current. Here, I get this picture from a book to make an example for us. At first, we have individual ABC as our current customer. We will use available data, such as transaction, demographic, behavior, and combine with unavailable data that customers don't give to us and we have to buy or do something to have it. From that, we can predict and find the profile that best describes high-value clients. Binary classification trees. About definition, this method can help us to find the best predictors of a 0 over 1 variables, which means yes or no. From that, we can select right target customer. Here I got a quick example to help you guys more understand of binary classification tree. A guy comes to bank for a loan, depending on his income to decide to allow him make a loan or not. We have 3 steps to create classification tree. Step 1. Choose the best explanatory variable with the lowest misclassification rate. The rate stands for that the outcome will never happen. Step 2. Separate the customer base with the best explanatory variable. Step 3. Repeat what we have done from step 1 to choose the explanatory variable with the lowest misclassification. And here, I got example how to do it. As you can see, I got 2 picture in page 120 and 121 with the data in a book for illustrating this example. The data gave us 2 predictor variables, gender and bought scuba equipment. So first, we have to choose what variable is more reliable and has the lowest misclassification rate. We assume that all male customers buy hockey equipment and no female buys. By using that theory and based on the table in page 120, we got the separation by gender in page 121. So we start to choose the quantity of customers based on the theory I give. And we have 4000 males customer don't buy hockey and 130 female customer buy that. Using that data, we have the formula to calculate the misclassification rate, which is 4300 plus 130, and divide all customer we have, 8600, and we got 0.48. Next, we will check the misclassification rate of the variable of buying scuba. We assume that customer who buys scuba is going to buy hockey. And based on the data in table, we got the separation by purchase scuba in page 121. And based on the assumption that I gave, we got 2690 customer who buy scuba and don't buy hockey. Also we got 1620 buy hockey but not buy scuba. And applying the formula of the misclassification rate, 2690 plus 1620, and divided by 8600, and the result is 0.5. We could see the misclassification rate of gender variable is the lowest one, 0.48 and 0.50, so it's more reliable and we choose that to do more. You can see the picture in page 122. From gender variables, we continue do that based on step 1 until we got the profitable and target segments. Logistic regression. And next part, I will talk about logistic regression. About the definition, that is the method when the dependent variable is binary and assumes only 2 discrete values, which means this method answers yes, no question. About the difference between linear regression and logistic regression, it's more suitable for predict the quantity when it has many observed values, such as price, quantity of people. But, logistic regression will answer yes, no question, such as a person. And how to do logistic regression, it includes 4 steps. Step 1. Write the probability of an event will happen or not. With P is the event that will happen, 1 plus P which means the event will not happen. Step 2. The formulate into natural log. Step 3. Make the formula of natural log related to linear regression. Step 4. Transform it so that we can calculate P based on log formulation. So I have an example to help you guys understand. At first, based on the table on the left, we got the estimate of alpha is minus 1.37 and beta is 0.39. Based on the formula that I give you on the screen, we will calculate the probability of contract extension. With alpha when the sales call is 0, and beta when having sales call, from that, we got probability of contract extension when we don't have sales call is 0.202. 1 divided by 1 plus a square minus alpha, and the probability of contract extension when we do sales calls is 0.273, 1 divided by 1 plus a square minus alpha and minus beta. From the formula that I mentioned in step 4, we calculate the odds, representing the chance of an event occurring to the chance of the event not occurring. We take 0.202 divided by 1 minus 0.202, and we got the odds of when we don't do sales calls and the result is 0.253. Similarly, we take 0.273 divided by 1 minus 0.273, and we got the odds of when we do sales calls, where the result is 0.375. Also, based on the interpretation of coefficients in page 124, we can calculate the log odds ratio as a square 0.39 and the result is 1.477.
Techniques to evaluate alternative customer selection strategies. In this section 6.3, we are going to show you techniques to evaluate alternative customer selection strategies. Simply, it's a way to decide which model to use to select and target potential customers. Moreover, when there are several alternative models are available for customer selection, we need to compare their relative quality of prediction. And then we choose the model that generalizes the best performance. There are two ways to evaluate the model's performance. Firstly, we have misclassification rate. To obtain the misclassification rate, we estimate the different models on 2/3 of the available data and calculate the misclassification rate on the remaining third to check the model performance. The misclassification rate is the number of false predictions divided by the total number of predictions made. A misclassification error rate or confusion matrix could look like the table 6.14. The number of false predictions is the sum of the off-diagonal entries, 56 plus 173 equals 229. Thus, the misclassification rate in this example is 229 1459 equals 15.7%, and this number 15.7% is meaning that the model would have 15.7% wrong. If the number is too high, it means that the model is no longer reliable. Secondly, the lift analysis. A lift chart shows how much better the current model performs against the results expected if no model was used. Base model can be used to track a model's performance over time, or to compare a model's performance on different samples. These are three formulas you need to pay attention. Lift rate equals response rate for each decile, overall response rate, *100. Cumulative lift equals cumulative response rate, overall response rate, *100. Cumulative response rate equals cumulative number of buyers, number of customers per decile. For example, look at the table 6.15. To calculate the response rate of number decile 2, you take the number of buyers, 1126, divide the number of customers, 5000, equal 22, 52%. Next, the lift percentage is calculated by response rate for each decile, 22.52, divide the overall response rate, 1138. And the cumulative lift, cumulative response rate, 35.18 plus 22.52, divide the overall response rate, 11.38. Next we move to lift performance illustration. Figure 6.13, decile analysis. The decile analysis distributes customers into 10 equal size groups. For a model that performs well, customers in the first decile exhibit the highest response rate. Figure 6.14, lift ALALYSIS. Lifts that exceed 1 indicate better than average performance. Less than 1 indicate a poorer than average performance. For the top decile, the lift is 3.09. Indicates that by targeting only these customers are expected to yield 3.09 times the numbers of buyers found by randomly mailing THSME number of customers. Figure 6.15, CUCUMLATIVE analysis. The cumulative lifts for the model reveal what proportion of responders we can expect to gain from targeting a specific percentage of customers using the model. So choosing the top 30% OD the customers from the top 3 deciles will obtain 68% of the total responders. Figure 6.16, model comparison using lift analysis. Logistic models tend to provide the best lift performance. The past customer value approach provides the next best performance. The traditional RFM approach exhibits the poorest performance.